Good evening. What you're about to see isn't a prediction dressed up as analysis. It's an observation about the present moment, a moment when the supply and demand dynamics of a particular asset have shifted in a way that most investors haven't yet recognized. And before you decide whether this matters to you, I want to be clear about something from the start. Understanding what has changed is far more valuable than reacting to it. So let's begin. For over a decade, we've operated in a financial system built on certain assumptions. We assumed that the monetary policies of central banks would remain accommodative. We assumed that energy would be cheap and abundant. We assumed that debt could expand indefinitely because interest rates would stay low. We assumed that industrial consumption would follow predictable patterns. And we assumed that the supply chains bringing critical materials to markets would operate without friction. Most of these assumptions are now breaking down. Today, we're going to focus on one material, silver. And through that lens, examine a broader principle about scarcity, industrial demand, monetary policy, and what happens when supply and demand finally realign. This isn't about getting rich. This is about understanding where we are in a cycle and what that means for your capital. Let me ask you a straightforward question. When was the last time you thought about silver? Not as a speculative asset or a meme on the internet, but as an actual industrial material with real-world demand that exceeds the current supply capacity of the global mining industry. Most investors don't think about this because silver has lived in the shadow of gold for centuries. Gold is the narrative. Gold is what gets discussed in boardrooms and on financial networks. Gold is what central banks hold in vaults and count toward their reserves. Silver, by contrast, is treated as an afterthought, a cheaper version of gold or a speculative trade for retail investors chasing leverage. But this perspective is precisely where the opportunity lies. And more importantly, this is where a material misunderstanding of market structure creates risk. Here's what has changed. The global silver deficit has shifted from a theoretical concern discussed by a handful of analysts into a measurable, observable reality. For years, we've been consuming more silver than we've been mining. Not slightly more, significantly more. And the gap is widening. This matters because silver is not merely an investment asset. It's a critical industrial material. It's used in solar panels, in medical applications, in electronics and RFID technology, and in dozens of industries that underpin modern civilization. When demand for these applications increases, silver demand increases. And right now, demand is accelerating while supply is constrained. Let's establish what we actually know. According to data tracking the silver market, global mine production has remained relatively flat for over a decade. We're producing roughly 850 to 900 million ounces of silver annually for mining operations. That number hasn't increased significantly despite rising prices and despite improvements in mining technology. Meanwhile, the uses for silver have multiplied. The transition to renewable energy, an industry that requires silver for solar panel conductors, has become a reality, not a future promise. Governments worldwide are mandating renewable energy adoption. Corporations are committing to net zero carbon pledges, and these aren't promises that evaporate when headlines change. They're backed by regulatory frameworks and capital allocation. Solar installations require silver, lots of it. This is the crucial point. You can't install solar panels without silver. There's no cheaper substitute that maintains the same efficiency. This isn't a speculative demand. This is structural demand that grows as the energy transition accelerates. Meanwhile, mine supply is constrained by geology and economics. Silver is primarily mined as a byproduct of copper, zinc, and lead mining. Miners dig for copper and silver comes out alongside it. This means that silver production isn't driven by silver demand. It's driven by copper demand. And copper mining faces its own challenges. Older mines are depleting, new discoveries are scarce, environmental regulations are tightening, and energy costs have risen. So we have a situation where industrial demand for silver is accelerating due to renewable energy adoption, while mine supply is stagnant due to the byproduct nature of silver mining. The math is straightforward. When supply stays flat and demand increases, scarcity develops. The question we need to ask ourselves is simple. If this situation is so clear, why hasn't it dominated financial headlines? The answer reveals something important about how markets work and how information flows. First, silver is a small market by the standards of global finance. The entire annual production of silver, valued at current prices, represents only a few $billion. Compare that to a single day of volume in the foreign exchange markets or equity indices. For institutional investors and major financial institutions, silver is beneath the radar. It's not material enough to move capital flows or change portfolio allocations, and that means fewer resources are devoted to understanding it. Second, there's a historical narrative that creates mental resistance. For decades, silver was treated as a speculative asset, something that retail investors bought when they wanted leverage to gold. This narrative is powerful because it persists even as facts change. Institutional investors often dismiss silver based on what they know about how it behaves, rather than examining whether conditions have shifted. Third, the supply question itself is complex. Supply and demand dynamics in commodity markets are genuinely difficult to track with precision. There are stockpiles scattered across the globe. There's scrap silver being recycled. There's silver held in private hoards. Tracking all of this requires detailed research, and detailed research isn't profitable for financial institutions. So most of the analysis remains in academic circles or independent research shops. And finally, there's the psychology of recent history. Silver experienced a significant run-up in 2011, followed by a long period of decline and stagnation. For investors who remember that period, silver carries the emotional weight of a failed trade. This creates a bias against revisiting the idea, even when circumstances change. But here's what matters. Markets don't reward consensus. Markets reward understanding positions before they've been fully priced in. And right now, the silver situation remains largely unpriced in the mainstream consciousness. Now, let's step back and think about the broader context. Silver doesn't exist in isolation. It exists within a system of monetary policy, interest rates, inflation, currency dynamics, and investment behavior. Understanding the silver deficit matters only when you understand the system it operates within. For over a decade, we've lived in a low interest rate environment. Central banks, beginning with the Federal Reserve, implemented quantitative easing after the 2008 financial crisis. They kept rates low, created new money, and expanded their balance sheets massively. This had profound effects throughout the financial system. Low interest rates make hard assets relatively more attractive because they don't generate yield themselves, they don't pay interest. So if you're a rational investor and you can earn 3% in government bonds with minimal risk, hard assets like gold or silver become less compelling. But if interest rates are zero or negative, that calculation changes. Hard assets become more rational even without yield, because at least they don't lose purchasing power to inflation. This dynamic is important because it shapes investor behavior on the margin. The past 2 years have seen a significant shift in interest rates. They've risen, not because monetary policy suddenly tightened, though it has, but because the market has demanded higher rates to compensate for inflation risk. This is a shift that reverses many of the assumptions embedded in the system over the past 13 years. When interest rates rise, bonds become more attractive relative to hard assets. But here's where complexity enters. Persistent inflation changes the equation again. If inflation is transitory, rising rates make sense and bonds become attractive. But if inflation reflects something more structural, changes in energy supply, changes in debt loads, changes in the supply chains that deliver goods, then rising nominal rates might not translate to higher real rates. Real rates are adjusted for inflation. When inflation is high, real rates can still be negative even when nominal rates have risen. Silver is sensitive to this dynamic. It benefits when real interest rates are low or negative. It struggles when real rates are high and rising. But silver also has another property that's less discussed. It's a proxy for industrial health. When economies are growing and industrial production is accelerating, silver demand rises. When economies are contracting, silver demand falls. This means that silver is a bifurcated asset. It has a monetary component. It's affected by interest rates, currency values, and inflation expectations. And it has an industrial component. It's affected by actual demand from real factories and installations. Understanding which component is dominant at any given moment is crucial. Currently, we're in a period where both components are positive. Industrial demand is accelerating due to the renewable energy transition. And monetary conditions, while tighter than they were, still reflect an underlying debt problem that won't be solved by higher rates. More on this in a moment. Here's something that rarely gets discussed in mainstream finance conversations, but it's essential to understanding where we are. The global debt situation has only gotten worse since 2008, not better. We didn't solve the debt problem. We extended it. We lowered interest rates and made debt cheaper and easier to service. Governments borrowed more, corporations borrowed more, and consumers borrowed more. The system became more indebted, not less. Now, as interest rates have risen, the cost of servicing this debt has become painfully apparent. Government budgets are straining under the weight of interest payments. Corporate earnings are being compressed by higher borrowing costs. And consumer discretionary spending is being squeezed by mortgage rates and credit card rates that have doubled from their lows. This is not a sustainable situation. And it's the reason why interest rates probably won't stay high. Eventually, the weight of the debt service will force central banks to choose between allowing a deflationary collapse or returning to more accommodative policy. Neither option is clean, but one or the other will likely prevail. If we get deflation, if the system deleverages and debt becomes even more expensive in real terms, assets like silver will be pressured. Demand will fall as economies contract. This is a real scenario that could unfold. But it would likely be short-lived because deflationary spirals are politically unacceptable. Governments and central banks would eventually act to prevent it, returning to monetary expansion. The more probable path, in our view, involves a period of uncertainty where policymakers attempt to control inflation while managing debt. This middle path, higher for longer on interest rates but not high enough to truly deflate the system, creates conditions where hard assets remain relevant but aren't dramatically overshooting. It's an environment of grinding real interest rates near zero or slightly negative. In this environment, silver's appeal lies in two things: its industrial utility and its role as a hedge against currency and credit deterioration. Both are relevant right now. Let's look at history for a moment, because it reveals patterns that feel timeless once you recognize them. In 1979 and 1980, silver experienced an extraordinary bull market. Prices rose from roughly $6 per ounce to nearly $50 in just 18 months. It was driven by monetary concerns, fear of inflation and currency deterioration, but also by supply constraints and industrial demand. When the bull market ended, it was brutal. Prices crashed. Investors who bought near the top and held were underwater for years. But here's what's important. The conditions that created that bull market were real. Inflation was real. Monetary policy was being driven by structural imbalances. And silver did have structural supply constraints. What ended the bull market wasn't that the fundamentals reversed. It was that central banks, led by Paul Volcker at the Federal Reserve, implemented policies so restrictive that they broke the back of inflation and demand simultaneously. Fast forward to 2008. We saw another period where silver benefited from monetary concerns. Central banks were expanding money supplies massively in response to the financial crisis. Silver, along with gold, captured some of that anxiety about currency value. Prices rose. But they also rose because mining companies had delayed exploration and expansion during the commodity bear market of the early 2000s, and new supply was constrained. These cycles teach us something. The intersection of a structural supply constraints, monetary stimulus, and industrial demand creates strong conditions for hard assets. And when one of these elements is missing, particularly if central banks tighten dramatically, the bull market ends. What's different now is that we have all three elements present, but in a new configuration. We have supply constraints in silver mining, but they're not as dramatic as they were in 2008. We have monetary stimulus that's less aggressive than it was in 2009, 2012. But the debt dynamics mean it can't be withdrawn completely. And we have industrial demand that's structural, not cyclical. It's driven by a transition to renewable energy that's backed by government mandates and corporate commitments, not just cyclical economic expansion. This suggests that the current environment might not create the kinds of explosive bull markets we saw in 2008 or 1979, but it does create an environment where silver is less likely to crash and more likely to slowly climb as supply constraints bite. One of the most important lessons in finance is that prices don't move based on fundamentals alone. They move based on the collective psychology of millions of individual investors and institutions making decisions simultaneously. Right now, there's a psychology of skepticism around silver. Retail investors have been burned before. Institutional investors dismiss it as too small to matter. And mainstream financial media doesn't cover the supply story because it's complex and doesn't fit neatly into the narratives they prefer. Stories about recessions, election cycles, or tech disruption. But psychology shifts, sometimes slowly, sometimes suddenly. What typically happens is that a few investors recognize a misalignment between fundamentals and prices. They begin to accumulate. For a long time, nothing happens. The price might even fall. This tests their conviction. Many abandon their thesis and sell, realizing losses or missing out on further downside. Then, eventually, more investors begin to notice the same fundamentals. They accumulate. Other investors notice the rising prices and wonder why. They do their research. They discover the supply deficit. They accumulate. And suddenly, what was ignored becomes sought after. Is this guaranteed to happen with silver? No. But the pattern is well established in market history. The other psychological element at play is what we might call asymmetric thinking. In an environment where monetary policies remain loose despite higher interest rates, where inflation remains elevated despite tighter policy, and where debt continues to expand despite fiscal rhetoric about restraint, investors are increasingly aware that something unusual is happening. The old playbook doesn't seem to work. And when old playbooks stop working, investors start looking for assets that perform differently. Silver has this property. It can perform well in inflationary environments, in deflation environments, due to its industrial necessity, and in stagflation environments, due to its monetary properties. This versatility makes it interesting when the future feels uncertain. Let's be precise about what we mean by a silver deficit, because precision matters here and claims get exaggerated quickly. A deficit simply means consumption exceeds production. In silver's case, annual consumption from all sources, industrial use, jewelry, photography, investment, and other applications, exceeds annual mine production plus recycling. The gap is real, measurable, and has been growing. Where does the excess consumption come from? Primarily from inventories held by miners, from private hoards accumulated over decades, from scrap and recycling that's invisible in official statistics, and from government stockpiles. In other words, we're drawing down existing stockpiles to meet current demand. This can continue for a period of time, but it can't continue indefinitely. The timeline for when this becomes a serious problem is uncertain. Some research suggests we could see meaningful inventory drawdowns within 5 to 10 years if trends continue. Other analyses suggest the timeline is longer. The honest answer is that we don't know precisely because global inventory tracking is imperfect. But here's what we do know. Inventories are finite. And if the deficit persists, they will shrink. At some point, maybe in 5 years, maybe in 15, the market will face a genuine shortage. Prices will rise, and high prices will either destroy demand or incentivize new supply. This is how commodity markets ultimately work. They're self-balancing. When something becomes scarce and valuable, more resources flow toward producing it. But there's a lag. Mining development takes years, so there's typically a period where prices rise significantly before new supply comes online to relieve the pressure. If you've already accumulated silver, whether as bullion, coins, or shares in mining companies, you're in a different position than someone considering it for the first time. First, understand that your time horizon should be measured in years, not months. The thesis we're describing plays out over a multi-year cycle, not a quarterly event. If you're checking your positions daily, or even monthly, you're going to create unnecessary psychological stress. The best thing you can do is establish a position you're comfortable with and monitor it periodically, perhaps quarterly or semi-annually. Second, understand why you hold it. This matters because it clarifies how to think about fluctuations. If you hold silver primarily because you believe in the supply deficit thesis, then when prices fall, the deficit hasn't disappeared. You've simply been given a better opportunity to add if you want to. If you hold it as a monetary insurance policy, protection against currency deterioration, then again, price fluctuations matter less than the underlying system risk you're protecting against. If you hold it as a speculative position hoping to time a bubble, you're playing a different game. That game requires technical skill, psychological discipline, and careful risk management. It's not the frame we're using here. Third, think about position sizing. One of the biggest mistakes investors make is overweighting concentrated bets. If silver comprises 50% of your portfolio and it drops 50%, you've lost 50% of your capital. That's not risk management, that's gambling. A disciplined position size, something in the range of 5 to 15% of a portfolio, depending on your overall risk tolerance and the rest of your holdings, allows you to benefit from the thesis while maintaining the ability to continue living your life and making rational decisions. Fourth, distinguish between silver bullion and silver mining equities. They're different things. Bullion is the physical metal, stable, uncomplicated, but requires storage and insurance. Mining equities are companies that extract and process silver. They offer leverage to silver prices. When silver rises, mining stocks typically rise more, but they also carry business risk, management risk, and geological risk. Bullion for insurance and conviction. Mining equities for leverage if you have higher conviction. Finally, be prepared for volatility. Silver is more volatile than gold. It's more volatile than most equities. Price swings of 10 to 20% in a matter of weeks are not unusual. If you're holding silver and this volatility surprises you or disturbs you, you've probably sized your position too large or you're not truly convinced of the thesis. Adjust accordingly. If you're not currently a silver holder, but the thesis presented here makes sense to you, the approach should be methodical and educational, not rushed. First, do your own research. Don't take our word for it or anyone's word for it. Examine the supply data yourself. Look at renewable energy installation trends. Understand silver's industrial applications. Read recent quarterly reports from major silver mining companies. The goal here isn't to become an expert. It's to develop enough understanding that you can defend the thesis to yourself without relying on others. Second, understand your time horizon and your capital allocation. Silver should be a long-term position if you're building it. Establish how much capital you're willing to allocate toward it. A common framework is to start with 1 to 2% of your portfolio and potentially scale to 5 to 10% over time, depending on your conviction and circumstances. This isn't a sprint. It's a multi-year accumulation process. Third, choose your vehicle carefully. You can own physical silver bullion as coins or bars. You can own shares in silver mining companies. You can own silver-focused ETFs. You can own shares in silver streaming companies. Each has different properties. Bullion is the simplest and most direct. Mining equities offer leverage but require company evaluation. ETFs are convenient but have fee structures. Each approach works for different types of investors. Fourth, establish a purchasing discipline. Don't try to time the bottom. Instead, use a dollar-cost averaging approach where you allocate capital regularly, perhaps monthly or quarterly, regardless of price. This removes emotion from the decision and allows you to accumulate at various price points over time. Paradoxically, this approach often outperforms trying to time entries perfectly. Finally, be prepared to revisit your thesis periodically. Markets change. New information emerges. Your personal circumstances shift. Every 6 months or so, ask yourself, does this thesis still hold? Am I still convinced? Are there new considerations I should account for? This isn't constant second-guessing. It's disciplined evaluation. Now let's address directly what separates disciplined investors from those who tend to lose money. There are specific behaviors that create problems, and understanding what not to do is sometimes more important than understanding what to do. First, do not leverage your silver position. Some investors, particularly in online communities, discuss using borrowed money to buy silver. This is extraordinarily risky. If you buy 100 ounces of silver with your own money and the price falls 50%, you're down 50%. If you buy 100 ounces with borrowed money using margin or a loan and the price falls even 20%, you might be forced to sell at the worst possible time to meet margin calls or debt service. Leverage amplifies both gains and losses. For a thesis that might play out over years and involves commodity volatility, leverage is a recipe for disaster. Second, do not chase momentum based on headlines. When silver has a big jump based on some news story, resist the urge to rush in and buy. These moments often represent temporary sentiment shifts, not changes in the fundamental thesis. You'll end up buying at peaks and selling at troughs if you're reactive. Instead, use headlines as opportunities to check your thesis. If silver jumps on a headline about renewable energy, does that change the supply deficit calculation? Usually not. Stay disciplined. Third, do not believe anyone who claims to know where silver prices are going. Anyone making specific price predictions, this price by that date, is either wrong or lucky. The only honest answer to where will silver be in 6 months is I don't know. The fundamentals support the idea that silver will be more valuable in the future than it is today. The timing, the magnitude, and the path to get there? Unknown. Anyone claiming otherwise is either oversimplifying or misleading. Fourth, do not check your position constantly. This creates a problem called recency bias, where your most recent observation feels more important than the actual thesis. If you check silver prices hourly and you see the price down 2%, you'll feel like something is broken. But zooming out to daily or weekly or monthly views reveals that small moves are just noise. Set a schedule for checking your positions, perhaps monthly or quarterly, and stick to it. Fifth, do not ignore risk management. Having a thesis and holding a position doesn't mean ignoring reality. If something changes, if government mandates for renewable energy slow, if new silver deposits are discovered and developed, if the debt situation resolves without the inflation we expect, your thesis might be wrong. This doesn't mean you have to exit immediately, but it means you should monitor for significant changes and be willing to reconsider. Conviction and flexibility aren't opposites. Strong investors are both. Wrong. Sixth, do not listen to noise. There's an enormous volume of content produced daily about silver. Some of it is thoughtful and research-based. Most of it isn't. Most of it is either promotional content trying to sell you something or emotional commentary designed to provoke reaction. Develop filters for information quality. Read research from established analysts. Review data from commodity organizations. But don't spend hours consuming commentary. It will only cloud your thinking. Seventh, do not use silver as a substitute for having a coherent financial plan. You still need an emergency fund. You still need to address your debt. You still need diversification across different asset classes. Silver is a component of a diversified portfolio, not a replacement for financial fundamentals. If you're buying silver instead of paying down high-interest debt, you're making a mistake. Finally, do not expect dramatic price moves immediately. The thesis we're describing is structural and plays out over years. If you're sitting with a silver position and 2 months later nothing has changed, don't panic. The deficit didn't disappear. The industrial demand didn't evaporate. You're just in the accumulation phase that precedes recognition. This requires patience. Let's address something that few financial commentators will acknowledge directly. The financial media has certain incentives that don't align with your interests as an investor. Media companies generate revenue through advertising. Advertising revenue is driven by engagement. Engagement is driven by novelty, controversy, fear, and excitement. Slow, grinding, structural stories about supply deficits don't generate engagement. Exciting narratives about crashes or booms do. This creates a systematic bias towards sensationalism and against the kind of patient, long-term analysis that actually generates wealth. When an analyst quietly accumulates an asset that's fundamentally undervalued, there's no story. When someone makes a dramatic call that the price will triple in a year, that's a story. You see this in how silver gets covered. It appears in financial media primarily when it's moving sharply up or down. When it's flat, nobody talks about it, even if the fundamentals are improving. This creates a narrative where silver is a speculative vehicle, when in fact it's becoming increasingly important as an industrial material. The other element of narrative that matters: silver has been caught in the gold narrative for so long that most investors can't separate them mentally. They think of silver as poor man's gold or as a speculative leverage play on gold. In reality, silver is moving through its own cycle driven by its own fundamentals. It's an industrial material as much as it's a monetary asset. Until investors broaden their narrative frameworks, silver will remain undervalued and underowned. Being aware of these narrative biases is important because it helps you identify where your own thinking might be distorted. If you find yourself dismissive of silver based on past narratives or media coverage, ask yourself, have I examined the current fundamentals, or am I relying on outdated frameworks? There's one more dimension to understand, and it's particularly relevant in a world where central banks are managing currencies and debt simultaneously. When governments carry large amounts of debt, there's an incentive to depreciate the currency. A weaker currency makes exports more competitive, it increases tax revenues in nominal terms, and it reduces the real burden of debt. So, in a world where most developed nations have accumulated record debt levels, there's structural pressure toward currency depreciation. This isn't a prediction of imminent currency collapse or hyperinflation. It's simply recognizing that the incentive structures favor weaker currencies. And historically, when currencies weaken, hard assets like silver and gold become more attractive. They're the alternative to holding currency that's losing purchasing power. This dynamic has already started in some cases. Several developed world currencies have weakened significantly against others. Emerging market currencies have faced pressure. The relative strength of the dollar in recent years is partly due to Fed tightening, but the tightening is unlikely to continue indefinitely because of the debt situation. Eventually, the pressure will reverse. In this environment, holding hard assets isn't a speculation about future prices. It's holding something that retains value when currencies weaken. Silver, being lower priced than gold, is more accessible for this purpose. You can hold meaningful quantities with reasonable capital allocation. This is also why physical ownership matters to some investors. An ETF or a mining stock are claims on silver or claims on cash flows from silver mining. But physical silver is direct ownership of the commodity itself. In an environment of currency stress, that directness has value. One of the most common objections to silver investment is that technology will develop substitutes. Solar panels will improve and use less silver. Electronics will become more efficient. Some new material will replace silver's role in these applications. This is theoretically possible, but practically unlikely to matter in your investment time horizon. Solar panel technology has been improving for decades. They use less silver per watt than they did 5 or 10 years ago. But the total amount of silver used in solar has increased anyway because installations have grown so rapidly. Efficiency improvements get overwhelmed by volume growth. This dynamic is likely to continue. Similarly, silver's role in electronics is driven by fundamental material properties. It has the highest electrical and thermal conductivity of any metal. When you need reliable electrical transmission, silver works better than alternatives. You might reduce the amount used through engineering improvements, but you won't eliminate it without sacrificing performance. The larger point: technology doesn't eliminate demand for scarce materials, it shifts it. New technologies typically require more scarce materials, not fewer. The smartphone requires more rare earths and precious metals than the rotary phone did. The electric vehicle requires more lithium and cobalt than the internal combustion engine required crude oil. In a world of increasingly advanced technology, the demand for essential materials increases. This isn't a guarantee that silver prices will rise, but it does mean that the demand side of the equation isn't about to evaporate due to technology displacement. We live in a time of genuine geopolitical tension. Relationships between major powers have deteriorated. Trade flows are being disrupted. Sanctions are being used as tools of policy. Supply chains are being evaluated through the lens of security rather than just economics. This matters for silver because a meaningful percentage of global silver production comes from Latin America, primarily Peru, Mexico, and Chile. These regions have experienced rising political instability, labor disputes, and environmental activism that's slowing mine development and sometimes halting operations. A localized disruption, a major mine closure, or a significant reduction in production from one region wouldn't permanently end the silver market, but it would create a temporary shortage that would require prices to rise enough to either reduce demand or unlock alternative supply. These kinds of shocks happen periodically in commodity markets. The broader point is that supply is more fragile than it appears. Major producers of silver are concentrated in a handful of countries. That concentration creates vulnerability. In a world of rising tensions and supply chain stress, that vulnerability becomes relevant. This doesn't mean silver prices will spike. It means there are multiple vectors through which supply could be disrupted, any of which would create problems for a system already running a deficit. Let's synthesize all of this into a coherent framework for thinking about silver as an investment. Silver operates at the intersection of monetary policy, industrial demand, and commodity supply dynamics. Historically, it performs best when real interest rates are low or negative, when industrial demand is growing, and when supply is constrained. We currently have evidence of all three. Real interest rates remain low due to the debt dynamics we discussed, industrial demand is accelerating due to renewable energy adoption, and supply is constrained due to the byproduct nature of silver mining and limited new deposits. This isn't a guarantee. Monetary policy could tighten dramatically and remain tight. Industrial demand could weaken if economies slow. New silver discoveries could be made and developed quickly, but the probability distribution of outcomes currently favors a higher silver price over a multi-year horizon. The best framework for thinking about silver is probabilistic, not deterministic. You're not trying to predict the exact path or the exact price. You're assessing the probability that conditions favor hard assets, and that silver, as a component of hard assets, becomes more valuable over time. If you believe that probability is meaningful, greater than 50%, then a modest allocation to silver makes sense from a portfolio risk management perspective. This is a good moment to address volatility directly because it separates investors who can hold positions from those who will panic sell. Silver is volatile. A 20% move in silver in a month isn't unusual. A 50% move over a year is well within historical patterns. If you've allocated capital to silver and the price drops 30%, you'll feel the pain. Watching part of your capital disappear is difficult psychologically, regardless of your intellectual conviction. Here's what matters. Understanding the difference between price and value. Price is what the market quotes you at any moment. Value is what something is worth based on fundamentals. If you believe silver's fundamentals support a higher price over time, then a price drop is temporary fluctuation that creates opportunity, not tragedy. This is easier to understand intellectually than to implement emotionally. It's the reason why position sizing and diversification matter so much. If silver is a small part of your portfolio and it drops 30%, your overall portfolio is down maybe 5%. That's manageable. You can continue with your life and your other decisions without panicking. If silver is half your portfolio and it drops 30%, you're losing 15% of your wealth. That creates genuine emotional pressure. Many investors will succumb to that pressure and sell at the bottom. This is why we emphasize discipline and patience above all else. The volatility of silver isn't a bug, it's a feature of how commodity markets work. And the investors who win are those who can maintain conviction through volatility. If you can't do that, you need a smaller position. The thesis we've presented is intellectually coherent, but conviction isn't something you inherit from reading an article or watching a video. It's something you build through your own research and understanding. Here's a framework for building that conviction. Start with data. Pull up global mine production figures. Look at annual production over the last 15 years. Is it growing or stagnant? Then look at end uses for silver. How much is used in solar? How much in electronics? How much in jewelry? Has that composition changed? Then look at renewable energy installation forecasts. What do projections say about solar installations over the next 10 years? If those installations are growing and solar requires significant silver, then demand is accelerating. Move into the supply side. Understand that silver mining is byproduct mining. Look at copper forecasts and copper cycle positioning. If copper mining is mature and new supply is limited, then silver supply is also constrained. This is the foundation of the deficit thesis. Then examine the inventory side. Research what government stockpiles exist. Look at recorded inventories held by futures exchanges and warehouses. Understand that official statistics don't capture private hoards, and that inventory tracking is imperfect. The point isn't to get a precise number, but to understand that inventories are finite and that depletion is a real possibility. Finally, look at the monetary backdrop. Understand current real interest rates. Understand central bank balance sheets and debt trajectories. Understand why interest rates are probably constrained. This provides the framework for why hard assets remain relevant even with higher nominal rates. By the time you've done this research, you'll have built conviction that doesn't depend on any single analyst or commentator. You'll own the thesis. And ownership of your thesis is the foundation of being able to hold through volatility.